Hello everyone, welcome to the ERU's May video edition of the Global Outlook. My name is Pat Thaker, Editorial Director for Middle East and Africa, and I'm joined by Benedict Craven, Principal Economist and Risk Manager for the Middle East and Africa. A busy time. Today, we are going to talk about the growing burden of debt for a large number of African countries, which really kicked off during the pandemic. And we'll be looking a little bit closely at some of the complex negotiations and where it is all heading this year. Growth is really recovering, or set to be recovering and bouncing back pretty strongly this year. Inflation is cooling. A large number of countries are undergoing IMF programs, which means fiscal consolidation is taking place. However, the risk of debt distress has not gone away and is in the process of negotiating a number of debt profile restructuring with a large number of countries from Zambia to Ghana to Kenya and other areas. So without any further ado, Ben, where are we with the debt situation and the complex negotiations that have been taking place, and where is it all heading?
Hi, Pat. Thank you for the question. Hello, listeners. To give a roundup, there are 3 African countries in default currently using the Common Framework for Debt Treatments, which is a G20 initiative set up during the pandemic, where, as you say, debt levels rose to unsustainable levels for lots and lots of countries. So those 3 are Ethiopia, Ghana, and Zambia. And there's also Malawi, which is seeking a restructure outside of that framework because it had a smaller creditor pool of restructurable debt and is dealing with creditors bilaterally. And Chad got a limited relief package in 2022, a rescheduling within the common framework as well. But Zambia has really been the focus of everyone's attention because it's been plugging away at a debt restructure the longest under the common framework. It approached creditors first in early 2021, and it's still not got a final treatment 3 and a bit years later, although we are arguably getting much closer. One of the big issues has been, for all the coordination benefits that the common framework gives, it doesn't include a deadline for talks. They're open-ended and essentially take as long as they take. In theory, there's a natural disincentive to letting things rumble on for too long, which is that the longer a country is left in limbo without a deal, the more its debt service capacity gets eroded as its economy gets degraded, potentially permanently. And that's obviously not in anyone's interest, sovereign or creditor alike. But in the case of Zambia and Ghana, this incentive mechanism hasn't really been effective at all because, well, both are commodity exporting countries, and high export prices mean that debt carrying capacity could easily improve in the future. And creditors have wanted to build this contingency into their deals with these sovereigns, and that's actually causing delays for Ghana and bondholders right now, and has featured in Zambia's talks too. And urgency's only really picked up for Zambia in the last couple of weeks because there's a very serious drought there now, and that's endangering the potential for value recovery clauses to kick in for its creditors. So there's not been this incentive to move fast, and there's not been an inbuilt mechanism in the G20 common framework to get things going quickly. So disputes between creditors have been allowed to roll on for a long time, and lots of these disagreements have really nothing to do with the defaulting sovereigns at all, and have everything to do with international political economy, specifically the West versus China, which has emerged as a major source of capital for emerging markets over the last decade, and which has very different views about how to restructure debt, Western creditors. Now, some of these knotty issues have been playing out internationally, have been important to resolve, and could help to inform debt negotiations in the future. But for countries like Zambia, it's been a very testing process. And our worry is that its experience in restructuring its debt might actually deter other sovereigns from attempting a timely debt treatment themselves in the future. And finally, there's a slippery notion of comparability of treatment among different creditor groups. And even though Zambia appeared to break through this impasse in March when it struck a revised deal with bondholders, comparability is far from being standardized in our view. So what Zambia has managed to achieve in terms of comparability treatment might not be easily replicated elsewhere.
Thank you, Ben. You mentioned that a lot of the complexity and the dragging of the negotiations is almost, it sounds like the G20 and the donor community is almost like battling with a number of complex issues along the way. So at a time when external borrowing is also very expensive than it has been in the last 10, 20 years. So which countries do you think are heading for a debt distress or a risky situation in the coming years?
Yeah, that's a very interesting question. And I say the answer to that is restricted access to market finance probably won't play an enormous role in what happens next for Africa's most at-risk countries of debt distress. I think it's unlikely we're going to see another default in a sub-Saharan African market where the sovereign has a very large external debt pile in absolute terms and a complex creditor pool, like we've seen in Ghana and Zambia and to an extent Ethiopia as well. Kenya, which has around $35 billion in debt, more than any nation currently in default, used to be on our list of countries that were at high risk of debt distress. But Kenya, as you know, Pat, was able to tap the market earlier this year to repay a Eurobond coming due in June. So we're feeling much more optimistic about Kenya. It's really the countries in sub-Saharan Africa that we consider to be at high risk of debt distress are ones with much lower levels of external debt, ranging from 500 million to around 2 billion. So I mentioned Kenya before, but to give, by way of comparison, Ghana has 30 billion in debt that it's trying to restructure, Zambia 13 billion, different orders of magnitude. So we're talking about much smaller debt piles in absolute terms for the countries that are still at high risk of debt distress, those that haven't defaulted already. Now, of those that are on the list, and there are 7, 5 have IMF programs, so there's a policy anchor there. And our view is generally the worst has passed for Africa's debt crisis when it comes to low-income countries. But it's still worth saying what would happen in the alternative scenario that these countries that are at high risk do end up defaulting. Most of the debt owed by these countries is multilateral concessional debt. So there's not actually that much that could be restructured as multilateral concessional debt is not really up for negotiation. And that could make it very difficult for these countries to secure a comprehensive reset on their debt. And any other creditors that aren't multilateral development banks might not be open to participating in debt relief at all if they have to shoulder the whole burden of restoring sustainability. So what would be interesting is if these countries do enter into distress, I think pressure would rise on multilateral development banks to share in losses, which is a demand China was pushing for earlier on in Zambia's restructured talks. And that was put to bed. It was firmly rebutted by these lenders, but easily could resurface if countries that owe a lot to multilateral development banks do end up facing distress. But that's sub-Saharan Africa, and that's the low-income countries that would be eligible for debt treatment under the Common Framework. Outside of the reach of the Common Framework, there are still 2 North African countries that are very much on our watch list. Egypt secured a raft of foreign funding deals earlier on this year, and that makes it far more likely that Egypt will be able to meet its external financing needs over 2024 and 2025. Egypt has a lot of debt coming due, foreign debt coming due, and previously this was a topic of much uncertainty. But even though Egypt might dodge an external debt default, its domestic debt burden is still really burdensome, given high interest rates in Egypt and the short-term nature of government domestic borrowing, which has caused the debt service bill to balloon and actually exceed revenue over the last few months, which is a dangerous moment for Egypt. And in our view, a restructure of domestic debt can't be ruled out, which would, of course, be very destabilizing for the local financial sector. And there's a lot of overseas participation in Egypt's debt market as well. This isn't our forecast. Actually, treasury yields are coming down because a lot of overseas money is coming into the debt market, but it's definitely a risk. The other major one on our watch list is Tunisia, where it's all really about external default. Tunisian policies working firmly against there being a new program with the IMF access to finance for Tunisia is completely off limits, and the country's got a very large repayment profile over the next couple of years, including to the IMF itself. Now, Tunisia drew down foreign exchange reserves to meet a bond repayment earlier this year, and that could be repeated in 2025 when another bond comes due. But the situation's certainly fraught with danger. It really depends if Tunisia can keep the current account deficit in check. We think it can, but Tunisia's got a $21 billion debt stock. It's a middle-income country, so there's no common framework to coordinate among creditors. It's got a very diverse creditor pool, and it would be by far Africa's most difficult debt restructure yet if there was one.
I agree. Both Egypt and Kenya stands out as exceptions where they've dodged the bullet for different ways, creative ways of getting finances. Kenya has been very proactive and secured another bond to avoid a default in June. Going forward, could there be a risk or a wave of defaults taking place that could affect the recovery of the continent?
Well, again, looking at the countries that we view as being at the high risk of debt distress, the combined economies account for just 1% of African GDP. To compare that against the countries that are currently in default and are seeking restructures, they're 10% of GDP. So I would argue that in terms of the aggregate impact on growth, the worst has already passed, as in the countries that were larger economies that were at risk of defaulting already have.
Thank you, Ben, for sharing your insights, and quite a broad area you've covered as well. And keep an eye on our latest views and insights on the topic and other issues in the coming weeks and months. And goodbye.